over the past few weeks, banks have been showing strength even on the days when rates are down. Are people just blindly chasing these bank charts, ignoring what looks like a possible next leg down on the 10-year?
Well, the banks are cheap. Barron's is bullish on the banks, and I think there was an article in Barron's that was saying all the geniuses have sold their Apple at the lows, and now they're all long the banks. I mean, remember all the guys who bought Apple on the lows or was buying it on the way down, now they don't own it, and Apple's going up. And they all bought the banks on the way down. Now they own them. And what happens if the banks don't go up? I mean, then they're going to sell them again, and maybe one day the banks will go up for real. I mean, the banks suck this year, okay? Everybody calls them cheap, and everybody knows that they're cheap on the wrong numbers. They're expensive on the right numbers. I mean, I think it's actually look at Josephine, if you go to the net interest margin slide, I think that's on the macro deck on slide, apologies, this is going to take a couple seconds. 23, slide 23. This is peak NIM compression. So this is, the third quarter is we've been saying this all year obviously, but the bear case for the banks is just getting started in the third quarter, or at least it's the best part of the bear case, because that's when the comparisons for net interest margins are at the highest point. So you're going back-to-back quarters now where a year ago, you could see that 156 and 154 basis points is the 10s-2 spread. That thing's down at 82 basis points today. That's down 70 basis points year over year. So this is going to be the worst quarter for the financials. Trading volumes are the worst that they've been. The IPO calendar they're trying to get it off its knees, but it still sucks relative, or certainly on a year-over-year basis. M&A on a year-over-year basis has been obviously bad. So the financials are entering the best time to be short them. I remember a lot of people buying the financials in the third quarter of 2007, and then again in the third quarter of 2008 because they were even cheaper then. But again, the yield spread doesn't lie. People do. If they don't do macro, you could tell me that something's cheap, but if I have a lower level of GDP growth in my model and lower levels of bond yields, then I'm not buying the financials. They're going to get cheaper, and that's, I think, important. A lot of people are obviously scared of being short the financials because on days like today, Deutsche Bank, I think RBS, Santander, all these raging POSs, these things are all up, right? So when you get the rallies, the low quality nature of the rally actually is rallying the banks because the banks are the worst performers in most equity indices. But again, that doesn't mean that they're not good short selling opportunities. It means that people are hoping that they're cheap, hoping they stop going down because they already own them. And I think that that's the differentiator in terms of how I thought about the financials and how a lot of people have been caught in them, and what we call them in 2016, they've been basically value traps.